Yesterday was a very dramatic day. It was a day that showed us that Bitcoin is going to $100 trillion in market cap. And to explain why, we're going to have to go on a journey that's going to take us to giant holes in the ground, a conversation with a diamond trader, and lots of weird graphs. So stick with this journey because it's an interesting one. All right, here we go. So crypto right now is undergoing not one, but two fundamental transformations. The first transformation is one of network effects. Network effects are one of the primary drivers of what differentiates the moat that projects have and their ability to capture market share. And people have not been thinking about it deeply enough because we are in an extremely network effect driven market. Money is a network effect driven market. Blockchains are network effect driven markets. Just generally transactions are a network effect driven market. But the second thing is that we're also right now undergoing a massive shift caused by a second massive change to general business structure, which is known as technological deflation, or the ability for technology to significantly change the cost structure of everything. But let's start with the announcement yesterday of a Bitcoin strategic reserve. And that word strategic there is very important. We'll come to that in a second. I think the first thing to understand is that while the document that came out didn't make big promises, it was extremely precisely written. And it made four very, very clear points if you actually read the document. Those 4 points basically point to the United States, by presidential order, the world's largest economy, the economy of the reserve currency of the world, stating unequivocally that Bitcoin is both separate and superior to any other crypto asset from the perspective of a store of value, a currency, and most specifically, a strategic reserve asset. And those 4 points, which I'm going to quote to you from the document, from the executive order, went as follows. The first was that the point was made that the United States government will not sell Bitcoin. Specifically, the quote is, BTC deposited into the strategic reserve shall not be sold. All right, so they are not planning on selling. In fact, they're not allowed to sell Bitcoin. Beyond that, and this is a point that was missed by a lot of people, they go on to say that the strategic reserve is expected to increase. So the US government will seek to purchase more BTC, shall develop strategies for acquiring additional government BTC. The next 2 points, so those are 2 points about Bitcoin, but the next 2 points are around other crypto assets, right? So the executive order itself is called the Bitcoin Strategic Reserve, and then talks about a digital asset reserve as well, which is a non-strategic reserve. So the US government will seek to purchase other crypto assets, but so the third point is that the US government will not seek to purchase other crypto assets. And the specific quote is, shall not acquire additional stockpile assets. Right? So we've got the strategic reserve and we've got the stockpile. And then the fourth point is that the US government views digital assets other than Bitcoin, right? That's the quote, as a separate asset class which may be sold, and it is hinted in the document, in the executive order, that potentially can be sold for Bitcoin, because one of the key elements is non-budgetary, the ability to purchase Bitcoin without having budgetary impact. Now, there's several ways that could be done, but effectively what it potentially allows is for the US government to take assets already in the books and shift them into Bitcoin. That would potentially include other crypto assets. I made the point today also that the United States government has 260 million troy ounces of gold, which they currently list at a value on their internal accounting of between $35 and $42, when the actual market price is well over $2,000. And so one of the things that has been floated since July by the Trump administration is that they would reprice that gold to reflect its true value, which would give Trump's administration discretionary spending without even having to sell the gold of an additional $500 billion. So that is one way that they could potentially seek to acquire the gold, the additional Bitcoin. So why is this important? Well, a lot of people think it's important because they're hoping that the US government is going to buy their bags, that the US government is going to pump Bitcoin and maybe other alts by purchasing them. Overall, the US government, as well as other governments, which are now poised to purchase Bitcoin, are the very smallest part of this story. It is their purchases which act as a signal, but not as the primary driver of what we can expect to see going forward. What we can expect to see going forward is much more important in the secondary and tertiary, second order and third order effects of this announcement. So what are the big second order and third order effects? The big thing that we have to pay attention to is the fact that Bitcoin now, Bitcoin and Bitcoin alone, has been declared a new major financial asset, one which can be used as a reserve asset. This has completely changed the status of crypto as a whole, and specifically of Bitcoin. It says these are no longer exotic assets. These are now fundamental reserve assets. Fundamental assets on the order of gold, on the order of real estate, on the order of government treasuries and government currencies. All of those assets that I've just described are all multi-trillion-dollar assets. And so basically the lid of what Bitcoin can be has been removed entirely. And we have to expect that the world will now start to view Bitcoin as this type of major asset rather than an exotic, highly volatile asset. And so what are the second and third order effects? Well, the second order effects is that other countries will now follow suit. This has already been happening. The UK has 60,000 Bitcoin, Ukraine has 40,000 Bitcoin, Bhutan has 13,000 Bitcoin, El Salvador has 6,000 Bitcoin, Kuwait has an undisclosed amount of Bitcoin, but apparently quite significant, Dubai in a similar situation, and then many other countries follow. But now effectively everyone is going to have to rethink their mix, their central bank's allocations of these reserve assets. But that is, again, just the smallest piece of it. The bigger piece of it is where most of the money in the world lies, which is in the general financial space. In the general financial environment, they seek to own major asset classes: real estate, gold, government treasuries, and equities. As of yesterday, a fifth asset class has been added to that list, and it is the first truly digital native asset class that has been added to that list. And so pension funds, sovereign wealth funds, hedge funds, family offices, insurance funds, effectively everyone who has the duty of allocating significant capital, and here we're talking about many hundreds of trillions of dollars, basically all the world's wealth, now have to completely rethink and readjust their books. This is not going to happen overnight, but it changes the significance of Bitcoin and by extension, the entire industry. All right, so that's really important. The second thing is that there has, whether we inside the industry have understood it or not, there has always been a major problem in our industry. And that problem has been that if you can come and say, look, Bitcoin might be flippant one day, or Bitcoin is digital gold, but Ethereum is this, and Solana is this, and so you end up with an asset class which has no solid foundation. You end up with an asset class which the mere uncertainty of what is actually valuable within this asset class makes everything less valuable. But now we've not only removed the roof of what the value here can be, but we've also introduced a floor. And that floor, that solid foundation, is Bitcoin. So coming back to what I was saying earlier, Bitcoin is now viewed as both separate from all other crypto assets, and so it now is canonized or has unassailable value, which means that the FUD that Bitcoin maybe doesn't have value, could be switched one day, or flippant, or maybe only captures a part of the store of value aspect of this industry, that's now gone. Bitcoin is now going to solidly stand apart for all crypto assets. And ironically, this is really good, obviously for Bitcoin, but also for everything else. Because while these other crypto assets have over the years called themselves altcoins and cryptocurrencies and competing blockchains, in practice they never were. They've never, Bitcoin has always been the most significant, most reliable, most trusted, but also most significant. It's always been taking out stablecoins, which are basically just US dollars, wrapped dollars, it's always been 70% of the market. And so when you create fear, uncertainty, and doubt around that 70%, and whether it can even maintain that 70%, you see the entire structure has no solid foundation if you're looking out at this industry from the outside. So separate and superior to all other crypto assets means that Bitcoin can float up, must float up now, to a valuation similar to that of gold, which is more than 12x from where we are now. Gold is over $20 trillion asset class. And from there, due to Bitcoin's inherent superior properties, the fact that it is designed for what is increasingly a digital world, the fact that it can move between countries instantaneously, the fact that it can be held by anyone with self-custody, we should expect it to increase above gold. But this also brings us to the rest of the story, which I think is the bigger part of the story. And the bigger part of the story is that not only can it move above gold, but it can move orders of magnitude above gold, because Bitcoin is actually the foundation of an entirely new way of thinking about property rights, about value, about the internet of value, and by extension, the overall internet. And so let's talk about let's go on a journey looking at what we are seeing here and trying to anticipate what it means for the future. So I started by saying that Bitcoin, with this announcement, is officially separate and superior to the rest of the crypto space. But this decoupling between Bitcoin and the rest of the crypto market is something we have been observing with great clarity over the course of the last year and a half, or almost 2 years at this point. Bitcoin has disentangled itself from the rest of the crypto world and has been racing ahead while everything else has been, in aggregate, treading water. The story gets even more interesting, though, when we look at this on a cycle-by-cycle basis. The pink line is the cycle of 2017, and you can see that from the starting point here, equalized to Bitcoin's performance over the course of that cycle, the sort of outworld massively outperformed Bitcoin. In the 2021 cycle, it actually did slightly outperform Bitcoin again, but that was attenuated. It didn't manage to recreate the outperformance of 2017, when the idea of altcoins with sort of the ICO market really took off and was new, fresh. Nobody knew exactly how to value it. As people have become more and more clear on how to value these assets, what we've seen is the sort of diminishing returns. And now, in this cycle, 2025, we actually see the underperformance. So this detachment from the rest of the crypto market, separate and superior, has been going on for a long time. This was going to happen anyway. In fact, it's not Trump who is introducing this idea. It's just Trump who is making what we all should have been aware of anyway official. So why is this so important? One of the primary issues that we have in the crypto space is that we've been promising this internet of value for the last 15 years, and it hasn't arisen. And the reason it hasn't arisen is because money and crypto networks, as networks, have to have network effects. But instead of developing network effects, what we've seen is the proliferation of lots and lots of small and increasingly smaller networks, right? So we've got Bitcoin, and then from there we saw Litecoin and XRP and Ethereum and Cardano, and since then we've seen thousands and thousands and thousands of other networks launch. Each network launch like this actually takes us further and further away from the internet of value that we're promising as an industry, because each of these today represents a little island of its own user base, but in particular its own security, its own programming languages, and its own liquidity. And the only way to move between these different systems is through centralized systems, or even worse, through insecure bridges. And so instead of creating an internet of value, what we created was an archipelago of lots of tiny little islands. And tiny islands do not great economies build. So the real question here is, does this take us forward towards Bitcoin establishing itself enough that it can begin to build the network effects. And so I think the trend that we're seeing on this graph, and that has been made official by the President of the United States, actually provides us with solid grounding to have Bitcoin act as the central hub for an entire world of crypto, which will become an internet of value if Bitcoin can actually utilize those network effects. And the primary reason that we've shattered into all of these islands has been because Bitcoin cannot integrate with anything else, cannot see transactions that occur outside of Bitcoin, cannot understand smart contracts. Basically, Bitcoin has been dumb, deaf, and mute, and therefore hasn't been able to capitalize or properly establish a true network around which we can build an economy, applications, and other systems. And that is the second big fundamental shift that we're seeing now. So in order to understand that fundamental shift, I want to actually take us out of our industry, because sometimes it helps to look at things from a third-party perspective. I was traveling back from Consensus Hong Kong, and sitting next to me was a wealthy diamond miner on my flight, who had been in the diamond business. This diamond merchant had been in the diamond business himself for his entire life. But he was a third-generation diamond merchant. And he spent the entire flight in a drunken way being extremely honest with me about his business and telling me that he was bemoaning the state of the diamond industry, and he was dreading the fact that he was going to be the last in this line of diamond merchants. His son would have no business to inherit. And why? Well, the reason is because the structure of the diamond industry changed fundamentally. And part of that story, most of that story, can be told in this graph. So here you can see that lab-grown diamonds, by the end of 2022, had gotten to the point that they were close to 50% of the entire diamond market. And that by 2022, people couldn't ignore something which had been obvious for quite a few decades, which is that lab-grown diamonds are indistinguishable, or in fact, superior to rough diamonds, to diamonds that you dig out of the earth. The diamond industry, and really all of its consumers, had been ignoring this fact for some 10, 15 years. But by 2022, it was no longer possible. And so what happened in 2022, and you can see that that's the peak price for diamonds. That very year, it went from having its peak price to absolutely crashing and has not recovered. In fact, this graph, if you project it forward, is going to keep going down, because the cost of producing man-made diamonds is just so much lower, but more importantly, is getting lower all the time. Okay, cool. So what has that got to do with what we're doing in crypto and what we're doing in Bitcoin? Well, we've been calling our industry the blockchain industry. And I think this is a deeply, deeply misleading term. It's misleading not other people, it's misleading us as an industry. Because that would be like the diamond industry calling itself the digging holes in the ground industry. And if that industry was as confused about what they're building as we are, then they would have giant conferences just like we have about blockchains. Instead, they would have giant conferences about holes in the ground. And why do I say it's a deeply misleading term? Because nobody in the world wants a hole in the ground. And nobody in the world wants a blockchain. What they want is what blockchains can provide, which is immutable assets, immutable transactions, and immutable applications. Or in other words, verifiable assets and verifiable compute. And so by calling our industry on the basis of sort of like the technology rather than the product, we confused ourselves. So coming back to the diamond industry, if they had done the same thing, you'd go to these conferences, there'd be giant diggers there. They would talk about how quickly, the speed with which they're able to dig holes, the throughput with which they're able to move gravel out of the holes with their trucks. You would have this bridge sector, right, building bridges over the holes, or digging tunnels between the holes. You would have people taking pictures of the holes and claiming that these unique pictures are going to be the new form of art, our version of NFTs. And you would have holes, where communities would be trying to buy shares in the hole because the hole was called Trump or Melania. right? Deep confusion about what is actually valuable here. And because of that deep confusion, nobody would have noticed that the fundamental value, right, the actual diamond, or in our case, the actual assets that you can own and the way you can create them, its cost structure was changing dramatically. All right, so are we seeing these kinds of curves in our industry? And the answer is yes. So what I'm showing you here is a log graph of the cost of ZK proving, right? And so what you can see is what some people have been calling the Moore's law of ZK, right? That the cost of compute in Moore's law drops dramatically. Here, the cost of ZK proving is dropping dramatically, but that's actually not a good term for it, because in Moore's law, you double the number of transistors every 18 months. Here, the cost of proving, the number of ZK proofs you can produce with a single chip, is going up not 2x every 18 months, but 10x every 18 months. So why is that important? Well, the reason that's important is because our industry is the verifiable compute industry. And turns out that ZK is like man-made diamonds. So the old way, for the last 10 years, ever since Ethereum launched, the way we've been doing verifiable compute, which is what we call smart contracts, right? But that's a bit of a confusing name. Let's bring that name down to a technical actuality, right? The way we would do smart contracts or verifiable compute is we would take the entire instruction set, the entire piece of software, the entire blob, the entire VM, and all of the data, and shove it into a blockchain. That was the method that was invented. The massive innovation of Ethereum was that it allowed us to do verifiable compute, but at a cost. And that cost is you massively bloat the blockchain, and even worse, the way you do the verification is that every single full node and every single verifier rerun every single computation. It is the redundancy of everyone rerunning the computation that makes the computation, that makes the smart contract verifiable. But obviously there's a problem here, which is that that system does not scale, is extremely expensive, because you're redundantly performing the same computation many tens of thousands of times when you actually only want to do it once. So that is like digging a hole in the ground in order to get out a diamond. But where we are now is we've actually got a way of creating these diamonds cleanly and efficiently in the lab, and that is ZK proofs. So what does ZK proofs allow? ZK proofs allow you to take a piece of software, run it on just one computer, and then create a proof of that computation. So you can go, basically just by doing that one single action, you can reduce the cost of the verification itself by 10,000 times, but you can also reduce the cost by reducing the need to have a smart contract blockchain, a smart contract chain at all. These smart contracts can live effectively unchained on any computer in the world, in the same way that a website can live on any computer in the world and doesn't need to be replicated many, many thousands of times, and everyone needs to maintain a store of the entire internet on their computer. In other words, we're starting to get close. If we can get zero-knowledge proofs to be cheap enough that they could actually replace smart contracts, if we can get ZK verification to be cheap enough that it can replace verification via redundancy, then we can build a true internet of value, right? Something that looks very much like the internet, where in the internet we have computers that send information one to the other through what is called IP, right? IP packets, information packets. We would be able to have a world of computers that send value to each other through proof packets. And what this graph is telling you is that the cost is coming down so quickly that we already are in that phase. It's just that our industry hasn't adjusted yet. And not only are we already there, but things are going to get juicier and juicier. The cost per transaction of doing the same kind of smart contract transaction or token transaction that you would be doing on a chain today and would cost you maybe a few dollars or a few cents will soon be using ZK verification possibly 1,000th of a cent, too cheap to meter. And the time it will take, instead of it taking, minutes or seconds to do a verification, verifications will happen in sub-second timeframes. In other words, too short to notice, instantaneous. And so the very idea of smart contract chains as a necessity right now is being questioned, and it's being questioned not by people, but by the President of the United States on the one hand, and by the reality of maths, by lines on a graph on the other hand. So what does the future look like? Well, the future looks like the ability for us to build out a system where thousands of different assets can live on all kinds of different execution environments. Some of them will be single computers, some of them might be chains built for this purpose, or adapting themselves. Some of the chains today that exist might adapt themselves to this purpose, and generating large amounts of transaction and activity at extremely low cost and extremely quickly. Exactly the kind of environment that you would want for AI agents to be interacting with themselves. Exactly the kind of environment that you'd want in a world where there's massive amounts of slop being created by AI agents, and people want to be able to verify that assets, not just financial assets, but any asset, any information is being created by humans, and exactly the kind of system that you would want if you're large financial institutions who want to be able to transact seamlessly across borders in the world that we already exist in, but now with Bitcoin becoming, a canonical top 5 asset, we're definitely heading into at speed. And so for all of these reasons, privacy and verification, AI systems, institutions, this is the structure, this Internet of Value that we've always been talking about. The part of the story that I haven't mentioned is that none of this works unless there is a, not blockchain, but a ledger to which all of this can settle. A ledger so trusted, so global, and so lightweight and reliable that the entire world can trust it. And it turns out that we have one like that. In fact, yesterday the President of the United States told us exactly what chain that is. It's Bitcoin. And so we're now in a world where Bitcoin is a major asset, is a global ledger, accepted soon by everyone. 2, around it, we can build an extremely fast and cheap Internet of Value. And so the only question remains, is there some way to connect Bitcoin to ZK? And that's where Boss comes in. This is the world that we've been anticipating. These are the trends that we've been looking at. And we've been surprised that the rest of the world hasn't recognized that this is the future that we're moving towards. But we did. And we've been building the technology that allows Bitcoin to act as the global ledger and settlement system for an Internet of Value driven by transacting in packets of verified compute via ZK. That's the world that we're heading into. And that is what Bitcoin allows. So the world that we're heading into, instead of being stuck in this uncomfortable position that smart contract chains have been in for the last 10 years, which is they're not as trusted as Bitcoin, but they're not as fast and as scalable as Web 2. Instead, what we're seeing is the separation of these things into a settlement mechanism as trusted as Bitcoin. In fact, more trusted than Bitcoin because it's Bitcoin after yesterday's announcement, and a true Internet of Value, which actually works like Web 2. And therefore can be as fast, as cheap, and as scalable as Web 2. And connecting these two in the middle is Bitcoin OS. Bitcoin has had win after win over the last 16 years, an amazing journey. Bitcoin is the global ledger and settlement system.